Well, it's topic of the day. We were last week. We talked about how a buyer's agent made their paycheck. If you're interested in that, go ahead and catch that video on our YouTube channel, Cavins Realty Group, and just see how a buyer's agent makes their money. Today, we're going to expand over on the client side a little bit and talk about first-time home buyers and what that all entails. So we're going to get the prospect of some buyer agents, and then we're going to get the prospect of the lender as well on this. So take it away, panel.
First time home buyers. Oh, you just talking
Well,
about first time home
yeah,
buyers.
well, I
So.
mean, let's start with the fun stuff. I think one of the things that people don't realize is that every state has their own setup to help first-time home buyers with their first purchase, whether it be down payment assistance, closing cost assistance. It all goes on top of your normal loans. And one of the cool things that Tennessee allows is you can still utilize their first-time home buyer platform, even if you were a previous homeowner, if you're moving to a targeted area, or if you're a veteran that's moving into the state of Tennessee. So, you get PCS from or moved for the job from, say, California, and you had a home and you moved to Tennessee, you can still utilize the first-time home buyers platform as a veteran. They've got some extra incentives also for your heroes. So your paramedics, your firefighters, your police officers, nurses, teachers, much better rates than what are generally standard out there at no cost to you, where the rest of the community is having to use more money in order to get that far down in today's world. I think it's a great thing to be able to get there, and they're not really stringent. I mean, a 640 credit score is really not asking a lot when you're giving so much away. Some have option for a second plus mortgage to cover stuff, so that would be up to $15,000 or 5% of the sales price, and others a $6,000 forgivable grant. After 10, 15 years in the home, you don't own any responsibility at 6K. So out here where we are, you can utilize a USDA loan, the forgivable 6K, get maybe a 1% seller credit, 1.5% seller credit, and you're basically moving into the home for zero out of pocket. I mean, it's a really, really good way to establish home ownership and to start gaining that wealth under your name versus somebody else's.
And if we, I've been very, very good. Well, not very good, but very lucky at times that the amount that we asked for the sellers to pay, we didn't use it all, and my buyers walked away with a check, a little small little check, and it was like, it's not a great big amount, but it's enough, sometimes to help pay for maybe a U-Haul, or get utilities turned on. I mean, so I think that's very helpful too.
Some of the other things that I've seen utilized with that when there's an excess of money is the comfort of having a 2-year home warranty, which are a
Right.
little bit more pricey
Right.
than the 1 year, but
Right.
you get your first 2 years with a huge protection on something taking place that you weren't maybe paying attention to or weren't used to the general maintenance of it because you're a first time home buyer.
Right.
To have that security as like an extra insurance policy that was just paid through the transaction, not out of your pocket, it's a huge benefit.
Yeah.
The other thing is a lot of times that extra money buys down the points,
Absolutely.
and that way then their interest rate points are bought down to where they don't have to pay such a high interest rate. So that always helps as well.
I think it depends on what your plan is if you're going to buy your points down. I think if you're planning on staying in that home for a while, then it's worth it. But if in the next 5 years you're going to have to make a move, for whatever reason, like this house is not like you buy a little 2-bedroom 1-bathroom house, and then you decide to have you decide to grow your family, and you have a couple of kids, and that you need to you're going to go further. I wouldn't necessarily use the points as buying down my points, as maybe using it toward other things.
We make sure to go through the math on that.
Yeah.
Right.
So, if it's going to cost you $5,000 to get, say, a quarter point, half point lower on your interest rate, if you're only saving $25 a month,
Right.
you have to go through how many months to recoup
recoup
that $5,000 at
Right.
$25 a month, you might as well keep that in your bank account
Correct.
and offset that higher payment than to put it towards that. So we kind of look at that and just make sure that, you know, the right steps that we take are the best financial choice. And if
And
we need to, we put a game plan in place for that. I mean, how awesome would it be to take that $5,000 and put it into a 6% high interest
Correct.
yield checking account and let it make money for you?
Right. And see, that's what I think people get so hung up on interest rates and focus so much on interest rates. If they would just kind of think things through a little bit different and what your goal is for the future. Is this could be your forever home, or is it just going to be a temporary home because you're a first time home buyer? And I don't think people think that through. They just get so hung up on, oh my gosh, the interest rates are, you know,
They
6%.
They make more though on the other end. You know, they have a cheaper interest rate from the get go. Then they're paying more towards the principal. So when they do sell that house, they are making more money on that end.
They
So-
can too, but then you've also got where if you instead of paying that extra 5,000 towards that buy down, like he said, put it into a high yield account, and you're going to make more money.
I don't know.
So
I've got
some interesting math for you. So
we're
everybody
doing math.
everybody knows that it's a good idea to be in a 401k or an IRA. Plan for your future. It's going to be money that grows on your money, compound interest. So if let's just say 10% is what you would gain on your money inside of an IRA, that's pretty good, right?
Yeah.
10% year over year. If you took $10,000 and you bought a $100,000 house, so 10% into it, those houses are generally gaining at 3%. That means your whole house value, $100,000, made $3,000. So your $10,000 investment made now $3,000. That's 30% rate of return.
Right.
Housing can compound your wealth much faster than the stock market.
Oh, yeah.
Or savings or bank. I mean, it just, you'll make more money.
A lot of your wealthy people, they distribute their wealth in different places. A lot of them, of course, will always be number one bucket. It's going to be real estate. And then they're going to go into other aspects of it, stock market, mutual funds, those kinds of things, stocks, bonds, all that. So I think if you get a good financial advisor to point you in the right direction, that would be great. Do you know anybody that's a good financial advisor?
I sell money.
You're just a lender. I mean, you sell money.
I know a couple of people that I trust to advise appropriately. But the number one thing is if you have any fear or any reserve about buying a home, you're not ready for a financial planner.
Absolutely.
Oh, yeah.
Absolutely. Well, taking the conversation back to the first-time home buyer, not necessarily investing and all that.
I forgot that's the topic.
So first-time home buying, who qualifies? Who will qualify? How do you get qualified? What's that process?
So the qualification is simple. It's just like a standard loan, because the first-time homebuyers platform, THDA, Tennessee Housing Development Association, is just support on the standard loans you've all heard about: conventional, FHA, VA, USDA. There's nothing different. They've added something on top of that. So as long as you have a minimum credit score of 640 and you can afford from a debt to income perspective, just like any other loan, you would have those resources available to you. It's not anything different or anything more challenging to get approved. The only add-on is that there's a class from the time that you ratify under contract, you've won a home, to take a quick class that just talks about basic finances to help out and ensure that the education is there so that you don't walk into simple hurdles that you could have been educated before. The class is not hard. It's not rocket science. It's just a qualification in order to have those resources. So it's a very,
And it's
very
an
easy
online
process.
class.
Mm-hmm.
So it's not like an in-person
Now,
class.
it's true that if you've bought a home in the past, you're able and eligible to use the first-time home buyer experience as well, as long as you haven't owned a primary residence within the past 3 years. Is that accurate?
That is correct. So if you have not been on ownership for a property where it was your primary residence in the last 3 years, you are re-eligible as a first-time home buyer again. That is the qualifying number. You can have property that you've owned. Say your grandfather died and left you a farm in Missouri. you're on title now. You have ownership and property. But because you've not utilized that as your primary residence, you are still eligible for the first-time homebuyers platform.
Well, there you go.
What about talk about DTI and explain a little bit about percentages and what it actually means.
Sure. DTI is how we look at your affordability and ability to repay the loan. We take into account everything that's on your credit that you have monthly obligations for, and then what the proposed mortgage is going to be. And we qualify that against how much income do you bring in. So what is your debt to income? Tennessee Housing Development Association's just slightly more restrictive. So they're maxed back in debt to income ratio, meaning all things considered, if you won that home and you got a loan, is 45%. So we're talking about 45% of your gross income will take care of the home and anything that's on your credit currently. Some of the other loans go a little bit higher, but they don't allow any type of first-time homebuyer support. So it's kind of keeping you in a very good position so that you don't feel house broke.
I seen a post yesterday when I was scrolling through. Some girl was wanting to buy. She was trying to buy a house, and she was all excited. She's been showing pictures and stuff, and then she just posted yesterday that she can't because her DTI is too high. So explain a little bit more detail about DTI it being too high, your debt to income being too high, because you have to have a certain percentage left over.
Correct. So your debt to income ratio being too high means that you're over the threshold for it not to be a financial strain on you. It would be, you could have credit cards, student loans, vehicle payments. These are all things that you want to be conscious of. I know the vehicle is beautiful and whatnot, but a $900 a month vehicle
I have one
payment,
that's paying over $1,000 a month.
and so we look at that. Let's just say you're bringing in $3,000 a month gross income. 50% of that would be $1,500. So you can afford $1,500 for the home and for any of the other things that are on credit. Now, we don't care about other things that are on credit. We don't care about your gas bill, your grocery bill, anything like that. Your actual credit obligations. So that situation would be that there are a lot of other things that are taxing her finances because it's already on credit. You've already pulled credit. That's one of the things that getting with a lender and an agent and putting a plan in place can help you out and be more successful, because we put that plan in place. Hey, these are the two things that are hurting your debt to income ratio the most. Let's focus on paying those down while we get you into the timeline of buying a home. If you reach out a month and a half before your lease is up, and those are the situations, you're more than likely going to be staying in place.
Mm-hmm.
You need a what? I guess reach out. How many months ahead of time do you think if you're renting?
As far as you can.
I've always said 6 months is a good starting point just to take a peek, soft pull, understand what's going on, and hopefully you get the green light, thumbs up, you're doing great. That way, the next 6 months, if you're already in that position for the size home that you're looking for, all we're looking to do is improve your situation, whether it be, hey, this is where I would pay off, or hey, this is what I would save for being able to handle your closing costs, just in the event that you don't get any type of support from the seller or things of that nature. Or if you wanted to slightly bump your goal up a little bit and buy a little bit bigger of a house within that 6 months, you have a plan in place already. And we may be just talking 5 months after that, a month before it's time, and really getting things going. But at least you know that you had time to work on the things versus being put up against the wall with a rush timeline, like having to decide, do I renew my lease or not?
Yeah.
Yeah, what
And
about
that's not looking at houses 6 months ahead of time.
no?
That's not doing that. What that means is you give us a call. We connect you with Kyle, or if you have a lender of your choice, get with that lender 5 or 6 months ahead of time, because you really need to see what you look like on paper. What you think you look like may not be what you look like on paper. So there's a big
Credit Karma isn't always the most accurate.
All
No.
of those places that you can pay for online or go for free or whatever, and you look at your credit score, I guarantee you that is not your credit score. The Discover bill, put your credit score on there. I mean, lots of people put your credit score, but that's not your credit score. It won't be the same. I can almost guarantee that. I don't know of any other way to get your true credit score is from a lender. How else do you get your true credit score if you're not?
You get one free one a year.
You can
Yeah.
pay,
But
you
is that your score or is that
it's
just
not-
your
that's not-
report?
that's just a standard score. So there's scores and then there's FICO
Right.
scores. FICO scores are what we're using. It's a little bit more of a stringent policy on how they calculate your credit score. You can sometimes pay for that through the direct bureaus, but you're going to pay to get more accuracy. That's kind of got to understand that if you're getting something for free,
Right. You pay for what you get.
You pay for what you get.
Yeah.
So if you go to the bureaus yourself and actually pay for their services to get those scores, you'll get it, but you're only going to get that one bureau score. That
Right,
one
you gotta do
bureau
all
is not-
three.
You got to do all three. So it's far easier to just do a quick soft pull with a lender. It doesn't cost you anything. Put a game plan in place and execute your goal.
Now, let's
Well-
say they don't have credit.
So THDA allows for no credit. Very first thing that we're going to do is we're going to look for a 12-month history of rental. Got to ensure that the biggest bill of your life you've paid on time the last 12 months. So if you are in a home that your family owns, we're going to require 12 bank statements in order to show that you paid it on time. If you work through a landlord like CRG and whatnot, we're going to request from them to ensure that you've done it for 12 months. Then we'll look at two other credit lines that do not, well, two other bills that you pay for the last 12 months that do not show up on credit, i.e. your cell phone bill, your car insurance, Netflix, two other accounts to supplement that, and you will default at a 640 credit score. So no scores do not mean that you do not get the eligibility for home buying. It just means we have a couple other hoops to build up the profile of your credit because you're not reporting anything to the credit bureaus.
Okay, say that somebody's in that situation. They paid their rent on time, other than they had a couple weeks of issues, and they were 2 weeks behind. But then they call it back up right away. How much does that affect that decision if they had like one late payment?
That's a situational thing. And with approval from the landlord to be that 2 weeks late, the landlord should be saying and giving us they weren't late. We made an agreement that they could go 2 months behind. It's when you are 30 days plus late and the landlord was intending to get their payment, you didn't communicate with them, didn't put any plan in place. That looks a little bit more risky.
And
So
then,
it's
like-
really more situational because we get it. I've had people that got into a car accident and they were in the hospital for 8-9 days and didn't have access to a computer to make their payment. That's a reasonable reason why you were 7,
Right.
8, 9 days late on your rent payment is because you got into a car accident.
Right.
You know,
Or the bank put in the wrong card number
that too.
and
Seen that happen.
made you 3 months behind on your truck payment.
Oh no. So, let's just say, what
experience?
about self-employment? What if they're self-employed?
Self-employed borrowers are okay. We do need a 2-year work history, at least, to do an average of what you've been
What
filing
does
on
that
your
mean?
taxes.
2 years of tax returns.
2 years of tax returns, because you can make $100,000, say, building fences. But if you wrote off everything on your taxes and said, I had these expenses, this expense, this expense, this expense, so my tax liability is lower, which is what most CPAs and tax professionals do for you.
Right.
They try to save you from the man. Then on paper, you look like you only made $10,000 for the year.
Mm-hmm.
Well, that means that you have less than $1,000 worth of qualified income. Now, one of the cool things that has just changed, if you've owned a business for 5 years or more, we can actually take 1 year's average of your income. So if you had a stellar year, your business finally took off, we're only going to take the previous year's tax filings, and that will be your qualified income. We will not look back at 2 years. And that's a new thing that Freddie has changed their rules on. Fannie does not allow that, but Freddie does, which is a very beneficial thing for somebody who's had a developing business and finally broke through that tier of success. They can now go qualify for more of a home.
So is
That's
there
great.
another option is there another option besides using their taxes? So like if they do write off everything and for their taxes and so they don't show that they make a whole lot, is there another way around that?
There is, but we lose the first time home buyer support with Tennessee.
Okay.
So you have 1099 loans, bank statement loans, and other ways of qualifying it. It just doesn't fit the Fannie Mae and Freddie Mac guidelines. They're still great conventional mortgages, but they're going to have some different stipulations because of the risk of qualifying your income. But it is possible. We even do asset depletion. I've had many individuals that wanted to move to their forever home, but they had already gotten themselves into a point where they were only drawing Social Security, but yet they have these massive IRAs, 401 TSPs from the time that they did work. They don't have to liquidate. They just have to have 100 and I think 25% of what their purchase price is, have a meaningful down payment, and they qualify whether they're making draws on those accounts or not yet. So we
Kind of
know-
having it in reserved.
we know that they're going to be able to draw from that. We know that they're going to be able to do so for the home, but from a debt to income perspective, we're looking at offsetting this mortgage, but they're only collecting these meaningless IRS Social Security checks that aren't really paying more than your Verizon bill.
Yeah.
Or half your grocery bill.
Yeah, or half your grocery bill. Yeah, exactly. Half.
There won't be anything there by the time we get to be adults. I mean, get to be
There
retirement.
definitely
We are
needs to be
adults, but
restructuring,
retirement.
but that's a whole different topic.
Yeah.
So first time home buyers from a agent perspective, what should we be advising our clients to do?
They're my favorite. I love first time home buyers. But the very first thing obviously is to get with a lender. We've got to know where you're at. We have to, because we can't just start shopping for houses. You fall in love with it and then we can't move. You can't do anything.
You
And so
don't know what
waste
type
it.
of loan you're going to get.
Yeah, I have to know what type of house. Like if you only qualify for $150,000 loan, well, we know majority of houses that are $150,000 are very much a work in
Fixer-uppers.
progress. So there's a lot of equity a lot of sweat equity you're going to have put into that. So I think we just have to look at where they're at in the big picture, and then once we know where they're at financially, then we can start house shopping.
It's important for once we get the go from the lender to know what type of house, because not only do the first time home buyers have to qualify, so does that house.
Mhm.
Yes.
You know, because the banks, lenders, underwriters, they all have checklists. And it's because they want to make sure that they're making a great investment. They are giving you the money, but if you don't pay, you don't stay, and they take it back. And so when they take it back,
That's the new CRG motto.
when they take it back, then they have to be able to sell it to recoup their monies. And so it makes sense.
And as agents, we have a pretty good eye of knowing, because going through these loans and these transactions, when we're looking at houses, we can tend to, we're not inspectors, just full disclosure, we're not inspectors, we're not appraisers or anything, but we can look through and look at certain things and know if this is going to pass or not, really.
If there's
So-
chippy pilly paint, okay, that's gonna be fixed. If there's a hole in the window, if there's a hole in the floor, we're like, okay, those things have to be repaired before we can even close.
And that's part of the negotiation process.
Yes.
So-
And sometimes we can get that to go through. But then there's times where the seller's like, I can't put one penny into this house. I do not have the health or the money to be able to hire somebody to do that. So I've had people and buyers before to go in knowing it's at their own risk to go in and make these repairs just to get it to go conventional loan. Because a lot of those houses that have those kinds of repairs are only usually going to go conventional, because it has to be, like almost a really good solid house for it to go FHA, USDA, or VA.
So that she just brought up a good point. The house and knowing what you can and can't finance is a huge thing to know up front. And the reason for that is, like, for instance, USDA is very stringent on mobile homes or manufactured homes, double wide, single wide, triple wide. All those have different rules and regs to them. So if you walk into the situation saying, hey, I've read about this USDA loan, I really want to get this 0% down loan, and then you go out and look at a home, you may find out that manufacturer does not qualify for USDA.
Mhm.
And so here it is. All the other options, conventional and FHA, have a down payment requirement where you were not planning on bringing a down payment. So if we could structure ahead of time and know that this is the type of home, this is the type of and the amount of land that you're looking for, we may know up front that USDA does not work for your situation. We really need to find the qualifications for a conventional and FHA and let you understand what that budget now looks like before you fall in love with the home.
Another thing with USDA, it also matters with location. Not all
Yes.
locations are the same. So, like parts of Florence, Alabama, they are not USDA approved. But if you go out just a little bit, like say Zip City or somewhere like that, a lot of times they are USDA approved. Here, most of Lawrence County, I think all of Lawrence County is USDA. But like then you should get up to Murray County, we lose that ability.
There's some areas in Murray County that
Right, that are still considered, because those are considered rural. They're trying to bring people into those communities to build it bigger. That's the whole point of it being USDA. Those are rural areas to bring in people. It's not necessarily just for helping people with a no down payment. They're trying to bring in communities.
And you've got to be careful with that. I've watched too many in like Huntsville area. They've got a huge booming developments all around there, and the algorithms to create whether it's considered rural or not have literally changed in a 30-60 day period.
I could see that
being on the edge of it because of the developments and how much homeownership is in that area. And I think we're going to probably see the same thing from like a Cool Springs down south as well, where if you're kind of wanting to be around that edge area, get it in as soon as you can, because there is a chance as more developments go up, more homes close and whatnot, that is no longer considered rural. It'll be a little bit further south.
Yep. I think that's kind of like Columbia as well. If you'll go just
Columbia,
out, Columbia is going to not be in the USDA, but if you'll go outside of Columbia, say like maybe Chapel Hill, I think Chapel Hill falls into that. So you just got to go out just a little bit further to be able to get those loans. So I think that's where it's really important as an agent to know. And sometimes I have to call the lender and be like, hey, here's the address. They really are interested in this house. Will it go USDA? And they can pull it up.
there's zip code maps.
I know I've pulled it up before too, but when we was dealing with Florence, Alabama, they were it wasn't just zip codes. It got
That's
so close
Narrowed.
on the line. We were having to literally look at streets, and like a friend of mine, she bought a house literally 1 or 2 blocks away. It began USDA, and because they fell within that, they had to go FHA. So then they still wanted the house, but then they had to have a substantial down payment.
This sounds like a lot, but really getting with the right agent and the right lender, these are the things that you're paying us to do, is to look
Correct.
out for your best interest, do this investigative work, and ensure that we're able to do what your goal is. And if not, we put a different plan in place to get you to that goal.